Welcome to the Global Market Outlook for June 2022. My name is Gary Booysen. If you don't know me, I'm a portfolio manager at Rand Swiss, and I'm going to take you through what's happened over the last month and what you can expect in the month ahead. This video is going to be recorded. We're going to stick it up on our YouTube channel. It's quite a formative new YouTube channel, so please go and subscribe to us. We've just got over 100 subscribers, so there's a nice custom URL now. You just go to YouTube/C/Rand Swiss. And you can check out all the videos. We've had a whole lot of different content providers join us and stick their videos up there. So Viv's doing a little weekly update. We had Anthony Clark last week giving an overview of the small and mid-cap sector. But there's a whole lot of different content, so please go check it out. Before we really get started, who is Rand Swiss and what do we do for any new people on the call? We basically a financial services provider. We offer a number of different services, and these webinars and this video content is really to assist you in doing a couple of different things with us. So the first is online trading. So online trading is obviously, it's a very, how can you put it? It's a very isolated business, if you want to put it that way. So essentially here, you are taking control of your own portfolios. We're giving you systems and access, but you're buying and selling securities largely unsupported by a traditional stockbroker. Now, what does that mean? It means that maybe you don't have all the information. Maybe I think you need more support. So one of the reasons that we've got that with these webinars is to kind of try and assist you and let you do it on your own, but also try and help you to make money as best as possible. Because looking at the stats across our different business units, online traders do seem to struggle the most. They're taking probably too much risk. They're obviously not experienced industry professionals, and it does lead to some challenges. The next business that we have is our private broking business. Now, this is for people with slightly more money. Generally, a private broking account, we can allocate you a personal dealer. We do one-on-one advice with you. We really hold your hand through the whole, I suppose, equity investing journey. If depending on the account size, the fees are, there's many different ways that those fees are taken. So even if you do have a smaller account, there are ways still to get access to that service. It's got a couple of extra bells and whistles. Things like Anthony's research notes will go to specific private clients, but that's run by a guy called Werner. I'm sure he'll be happy to chat you through it. Managed portfolios is what I'm going to chat you through some of the performance stats today as well. But managed portfolios is where you are not managing the money yourself. You're not managing it with one of us, but ultimately you making the decision. It's where you give us money and say, please, will you invest? And we've got a couple of model portfolios that we run. I suppose this webinar also just gives you a little bit of feedback about how we're thinking about markets in our portfolios. And we take a look at some of the underlying companies that we hold, as well as general news and just the feeling in the market. Structured products. This is a business run by Viv Govender. It's more medium risk credit note products, some very, very exciting stuff that we're doing there. We're actually closing one on Friday with Investec, and then there'll be another on the 22nd of June. I'll just give you a quick update on that in a later section. Offshore transfers, a lot of our businesses are now international. Probably 85% of our assets sit in the international markets, not just on the local exchange, even though I am sitting in the JSE at the moment. It's just the demand that we felt from our client base, and to tie that all together, we have an offshore transfer service. We're obviously, as a South African, you face exchange controls, and there is quite a lot of administration around getting and moving money across the South African border. So we've got Christo takes care of that business, and there we. I suppose it just links all the international accounts together, whether you're buying a structure in Guernsey or you managing a portfolio in Switzerland, or you have a trust in Mauritius. We can tie it all together with our offshore transfers and treasury service, which is quite nice. Then Yaku, the certified financial planner, is in charge of our wealth business. This is more the holistic planning, where if you're not sure what you should be doing, you're not comfortable to say, I want to buy a managed portfolio at high risk or a structured product at a medium risk, and you don't understand what you're doing, and you really need someone to guide you through the process of retirement planning, of kind of correctly, building your asset class allocation. That's where you get your certified financial planners involved. And that's Yaku heading up that business. Obviously, we have tax-free savings accounts as well. This is kind of a little pro bono product that we've added on. It's just such a great, I want to call it a tax loophole, if you want to put it that way. Obviously, completely legal. But I mean, it's a tax-free investment that we believe every client should have. So we do it for existing clients. We do them as a free managed option. You can literally go and buy the Rand Swiss managed portfolio, Rand Swiss managed tax-free savings account. You deposit your 36,000 Rand a year, and we take care of the rest for you. It doesn't cost you anything other than it's a minute frictional amount when you buy the underlying ETFs, but it works out to a couple of basis points on the account. And other than that, there's no ongoing fees. So nice, cheap product. If we look at it, what is our history? We currently rank the #1 stockbroker in South Africa, which is incredible, and I'll show you why in a sec. We've also won the top tax-free savings account in 2020 and 2021, so the last 2 years running. We are ranked as South Africa's top tax-free savings account. We also won the People's Choice Award, which is largely thanks to you guys, the people that support us and the people that go and vote in the awards. Just to say thank you for the content that you're creating and the service that you're getting at the business, and obviously the innovative products that we've created. So we really appreciate everyone that got involved and signs up and goes and supports us when they come around. They're about 4 months away, and then we're going to be sending around the email just asking you to fill in that survey. Hopefully, it has been obviously a very, very difficult year from a financial markets point of view, but hopefully you guys, have felt the support and all the extra things that we're trying to do for you. As I said, last year we ranked #1, and this is ahead of things, like groups like Standard Bank or Standard OSD, which is Standard Bank stockbroking arm, PSG Wealth, F&B Africa, F&B Easy Equities, all of these, all the ones that I've just mentioned. I mean, they are Easy Equities and GT247 part of Purple Group. I mean, these are big listed companies that we're competing against. I mean, obviously, we're very, very proud to have done so well, but we've always been the underdog. We've always been the little guy trying to topple the big guys. And I was really happy last year when we managed to scoop the top award. What are we doing this year to try and improve it and just push things a little bit further? So we've really fleshed out our research offering, and this really does support specifically the online trading clients, but anyone who's trying to make sense of the markets at the moment. So we've always had our little Trader Connect service, which is run by Krista. We've actually built in a second analyst there as well. That's just giving you short-term ideas around price movements, very, very much technically based. Krista does a little webinar where you can ask him questions to go and look at the technicals on different setups on different securities. He'll take you through that. We've also recently launched the weekly wrap, which is mainly Viv's podcast combined with a research note each week. And we're going to kind of continue to build that note out, but that is also free to everyone. Obviously Trader Connect for online clients, and then what I'm especially proud of is obviously getting the Small Talk Daily research to selected private clients. This is really heavy-hitting institutional research in a sector that is very unloved. There's very little coverage on the stocks that Anthony Clark covers. And because of that, I think there's real alpha that can be generated in the local market. If you didn't see his webinar, it's up on YouTube. Again, just go to our YouTube channel. You can check out, I think we'll leave a link in the description below, but check out that video. He runs you through a lot of uncovered stocks. And when stocks aren't covered by professional analysts, what happens is you get real mispricings in the market, things that aren't trading at the fair value. And private clients and smaller clients that aren't facing the same liquidity constraints as big funds really can get in and out of those stocks and really pick up some bargains. So I think worth going and having a watch of that webinar as well. So with that introduction out of the way, I'm going to take you through the June global market outlook. Now, we cover equity markets, economics, a little bit of commodities, a little bit of currencies, and then I can take you through some of the managed portfolio decisions that we're making. So if you remember last year, if you join us each month, if you remember last month, I mean, it was tough. I mean, we have, when I say we, the globe, the S&P 500 specifically, the worst start to the year since 1939. It then actually got even worse. It was about 1932, I think was the first 91 days of this year. We haven't seen anything it's like it since 1932. So it's been a very, very difficult start for equity investors. And last month, I gave you guys 3 tips, just, relax, how to kind of emotionally handle the kind of volatility that we're seeing in the markets. We're dealing with things like massive inflation, big negative interest rates, specifically on US dollars. And obviously we still have the war in Ukraine, but we also had that very, very aggressive lockdown in Shanghai. And things were bad. It does seem to me, though, that we've had a little bit of relief here. So looking at the headlines for this month, and I normally just go and select a whole bunch of different things that I find interesting. We've seen a little bit of movement and a little bit of optimism. Now, last month, if you look at the fear and greed index on the left-hand side, this is actually, I just pull it off CNN. They take a whole lot of different indicators like the put-call ratio. They look at the VIX. We're going to look at the VIX in the next slide anyway. But they take a whole lot of almost fear and greed indicators, and they compile it into a composite. And it gives you a sense. I always like to put it up because it gives a nice visual sense of what the market sentiment is at any one stage. And if you remember your Buffett, you should buy when others are fearful, and you should sell when they're greedy. And there's no question that there's a lot of fear in the market now. Everyone that I'm speaking to on the desk, whether it's clients, whether it's the banks or the institutions or analysts that we chat to, everyone tells me that we're in for a rough 1 year to 18 months. Everyone is saying that to me. It's going to be a difficult market and a difficult environment. We've got inflation coming through. Everyone is concerned. Now, often when everyone is of the same view, that's a great indication that it's already priced into securities. And we've seen huge drawdowns in international markets without necessarily seeing a real impact on underlying cash flows, on underlying revenues or earnings. Now, I'm going to take you through some South African companies a bit later on, but that sentiment, that fear, tells me that it is probably a good time to be getting into the market. That's just what I'm feeling. Now, you are seeing a little bit of a subsidence of that fear. We've moved from extreme fear last month to just fear this month, and you can see there's the tracking of the gauge over time. Last month we were right down there. We've kind of like it's settled a bit. We're sitting at a ranking of 30 currently. Now, why is that? One, we've had Shanghai starting to open up a little bit, and that obviously is very, very positive for markets. We've also had, so with China, starting to look like it's going to get back to normal after following that zero COVID policy. Some of those supply chain disruptions we're hoping are going to work through the system. That, I think, just bringing a little bit of optimism in. From a Fed point of view, and we're going to look at the interest rates in a little bit. The Fed was fairly hawkish in its FOMC minutes, and it has obviously been aggressively hiking interest rates. We're seeing a tightening of monetary policy, and obviously that's a big input to the fear that people are feeling in markets at the moment. With inflation running persistently high, there's the sense that the Fed isn't able to just continue with this loose monetary policy that have buoyed specifically, equity asset prices, and that's where the panic is really coming from. At the same time, we obviously had the payrolls data, which I'll chat to you about in a sec, in 2 slides time, I think it is. Payrolls came in much better, so it looks like hiring is strong in the US. That again, it just speaks to the fact that the Fed is going to be concerned about inflation, that the US economy is running quite hot, and they're going to have to cool things down by maintaining that rate hike path. We obviously got output hikes from OPEC because oil is still persistently high. We're going to look at that under the commodity section. But oil price still at recently just above $120 a barrel, even after OPEC agreed to big output increases. And I suppose let's chat about that now. Or let's chat about that under commodities as well. So OPEC kind of trying to increase, but energy markets still very, very tight. And then we had obviously Elon Musk come out and say he's got a super bad feeling about the economy. And he froze hiring across Tesla internationally and is talking about cutting 1 in 10 of the workforce. So, pretty aggressive moves there. And if we start seeing executives around the world reacting in that way, that's obviously going to have real world impact, and the potential for a recession in the US and recession in other economies around the world is really, really likely. And we'll look at the US quarterly GDP numbers in a second, but Fed Tracker also showing that the US economy is on the brink of recession. Remember, recession is 2 consecutive quarters of negative growth. ECB has kind of joined the party on the rate tightening. They're a little bit behind where the Fed is. So they're winding down their bond purchases, and it looks like it's about 50-50, but we probably are going to get the first rate increases in Europe that come next month. And that's, again, just kind of increasing the weighted average cost of capital and really pouring a bucket of cold water on equity markets. So let's have a look at equity markets in general. So if you remember last month, this is basically a 1-month view. It's a 1-month heat map just of, this is specifically the US market. Last month, it was just red all over the place. We had a huge collapse last month, and it was really almost a capitulation in the big FANG stocks. So it was the Amazons and the Googles and the Apples just falling apart last month. And there really wasn't, I said to you guys last month, there was nowhere to hide. I mean, there was even the energy sector, which has been remarkably robust, what was most counters in the red. We looked at the international markets as well last month, also totally red. But this month, we are starting to see a patchy recovery. Now, whether this is a dead cat bounce, whether it's a bear market rally, as everyone is telling me it is, or whether it's the start of a real turn, no one can tell you that. Let me tell you, like it's impossible to know that. So just be careful when you read on Twitter. Someone said that this is the turn, or someone said that this has got another 6 months to go. You don't know that. The right way that we have always said to clients to deploy, we normally do phased implementations on all our portfolios, is to use that dollar cost averaging or rand cost averaging and slowly drip into the market. There's no question that people are concerned at the moment, but this, in hindsight, come 2, 3, 4 years time, you're probably going to be looking at these equity prices, and even if they're not the lows, you're going to probably be looking at them going, sure, I wish I'd been buying in at that stage, because again, it's panic. A lot of the negative news is already in security prices, in my humble opinion. If we look at it, I mean, we've seen a nice recovery in Amazon. Just on Amazon, are we going to go through local companies today because people have requested that? But Amazon specifically it did a share split recently. So just so that you know, if you're holding Amazon in your portfolio, it was a 20-to-1 share split. If you had one Amazon, you'll now have 20 Amazons and the share price is down. So if you had looked at it, it was a couple of days ago, you would have seen Amazon down 95%. You might have panicked and gone, what has happened as the a giant e-commerce retailer collapsed? No, it hasn't collapsed. It's just a share split. It's just giving, I suppose, smaller investors a little bit more granularity to their investment. It doesn't actually make a difference for the valuation of the company. Shares are just how you slice up a pie of economic value, and they're just slicing it into, each share is now being sliced into 20 units. So it brings down the price of the share, but it makes no difference to the value of the company overall. What it does do for retail investors, and it's always been a problem when Amazon is a couple of $1,000s a share. It's very difficult to get very granular exposure. If you're looking for like a 4.5% weighting to Amazon or 3.7% weighting to Amazon in a portfolio, having this big lumpy share price, Berkshire Hathaway is hundreds of thousands of dollars for the A-class shares. It's almost impossible to get into that. So I'm happy that Amazon did the share split. It allows us to be far more granular in our Amazon exposure in underlying segregated client portfolios. Remember, we've taken about $50,000 is a minimum lump sum investment into our offshore global portfolio. And with that, I mean, if you're buying 39 securities, or at least around 30 securities, do the maths. I mean, your Amazon is trading at 3,000. You can take, you can kind of take a 6% weighting at $50,000 or 12% weighting. There's no granularity. So this is going to allow us to get far more targeted with our Amazon, which I'm quite happy about. Looking at the international stuff, we're seeing a nice recovery. I haven't got charts up for you on this one, but we are seeing a nice recovery in China at the moment. We're seeing some relaxation of the gaming rules, so we've seen nice recovery in the Naspers and Prosus. Alibaba finally looks like it's starting to break out, and we do hold Alibaba in the portfolio for good or ill. We're still actually positive on the security even after the big collapse, because we've had it for a long time. Obviously, with that kind of China-US friction, and the idea that ADRs might be delisted in the US, people were very, very concerned. Obviously, the disappearance of Jack Ma, we've been through this before. I still think that it's worth having in a portfolio, not in a big weighting. I mean, we've only got about 2% weighting in our model portfolio, but it's worth having for the optionality. When Chinese markets come right, you can make very, very big gains or very, very small exposures. So for me, worth having Alibaba in a portfolio. You can just see, patchy recovery across the globe. And it's actually, maybe they kept on, maybe not, but some of it coming from commodity stocks like the BHP Billiton in Australia, up 13%. but also, in some of the more defensive stocks like GSK and AstraZeneca, the healthcare coming off a little bit, even though I think, looking at population demographics, that's, short term, but long term, healthcare stocks are still a very interesting place to invest. Let's look at the volatility quickly. So in terms of volatility, pandemic volatility is where we were up here, well above 80 on the VIX. The VIX is the volatility index, often called the fear and greed index. You can see that we have seen a subsidence over the last month. If you look on the right-hand side, the orange line, we're back to about 24 on the VIX, still well above the kind of 12 to 15 level we saw pre-pandemic. There's still certainly risk in the market. There's still a lot of fear in the market, but that has been, obviously a negative correlation to the S&P 500, which is the pink line. And you can see the recovery that we've had in the S&P 500. Does this mean, just from a technical point of view, that S&P is going to all-time highs again? I don't know. I mean, you kind of got, like, it looks kind of like mid-value. I don't have a strong signal that you should be buying into the short term or selling out. Like I said, if you're a long-term, I'm talking real five-year plus investor, great. I would definitely be buying into the market. If you're a short-term trader looking for kind of the next 2 weeks to a month, I would probably be trying to deploy new portfolios down at the bottom of this trend line. If we get a break of this kind of middle declining trend line, I would buy again. If we got a break of the top one, then you pile in, because then we're probably going to go to all-time highs. That's just like a small technical view on the S&P 500. But I think we're kind of mid-channel at the moment. I think we can easily see a little bit more upside in the short term. But like I said, longer term, that big correction, I mean, we are still buying at prices, kind of comparable to right back, last year. So we've seen a nice sell-off in the S&P 500 and specifically in NASDAQ stocks, and I think there is opportunity there for sure. So now, okay, I'm going to have to run through all of this quick. I'm going to go through all of these companies really, really quickly. so just for fun, because all of them kind of came out with results. We've had a very busy earnings season. So let's start with Reinet. Okay, so I'm just going to give you like the topical stuff on the different things. Remember, Reinet is Johan Rupert, essentially. British American Tobacco makes up about 30% of its assets. Pens Corp, which is Pension International Corp, makes up about half their assets. Pens Corp under a little bit of pressure at the moment, but British American Tobacco actually showing really, really strong growth. Just as they move into kind of those next-gen smoking products. The interesting thing in Reinet that I pulled out is people are getting conservative. So they've sold down, part of their private equity interests in True Arc Partners. They've also sold investments in RLG Real Estate Partners, really to shore up their balance sheet. We've seen their debt come down from 837 million euros down to around 233 million euros. So that's a signal that they are being very, very conservative in their capital deployment, and they expect interest rates to be up for a while. Still a massive discount to NAV in the company, so holding company still not being liked by markets. Okay, that's Reinet. Okay, let's move on to, okay, what should we do now? Let's move on to Lewis Group. So Lewis Group, okay, so we've got a couple of retailers. Let's actually start with Mr. Price. Mr. Price showing great earnings. I mean, headline earnings per share up 24 to 29%. They had, it looks like the looting that happened last year was, almost didn't affect them. So there was only about 11 stores looted out of their 1,592 stores. Their earnings are also getting a boost from their acquisition of Yappy Chef. Some of the base effects, the apparel is, they are taking market share in the apparel business, and some of this is base effects. So we are seeing like kind of a kick up from the COVID period, which is why you're getting that kind of like big increase. The good news is that they still, and I'll say good and bad news, but there's still some kind of earnings kicker to come in the next results as well, because their business interruption insurance hasn't paid out yet. They're still discussing that. We're actually getting Mr. Price's results out tomorrow, so we're going to get a clearer picture of what happened in Mr. Price. But it looks really, really good. In our local portfolio, we do hold Mr. Price, so that's why it's covered. Okay, Lewis Group also came out revenue up around just under 8%, earnings per share up 21%. So definitely seeing a recovery in these retailers. But they're saying, it's a very, very competitive economy out there, and the economic tightening is it's hurting them. They had 260 stores closed for violence in the July civil unrest out of their 819 stores. But yeah, Lewis, very, very liquid, and this is what I'm talking about. as a private client, you might have a look at something like Lewis, but I can never have a look at something like Lewis just because there isn't the liquidity in the stock to allow me to get in and out of client portfolios. But it might be an interesting one for you guys to go and have a look at. Nampak revenue up 24% for the period. So Nampak gets about 70% of its revenue from its beverage can business. Beverage can is doing really, really well. Whereas the other portion of their revenue is coming from their plastics business that makes up about 30%. That a lot more difficult. Interestingly, though, they're seeing obviously, in metals prices going up, just the inflation in commodity prices that's feeding into their business, but they are managing to pass that on to customers, which is always an encouraging sign. I think that's going to be key in any earnings that you're looking at, in the next little bit, is what is the ability of the company to absorb inflation. Nampak, this was 6 month results. They looked pretty good this month. We've had a couple of stock picks out on Nampak as well. In the hospital space, we had basically all Mediclinic, Netcare, and Life Healthcare all reporting. Life Healthcare looks like it's struggling a little bit. Their theatre minutes up 11.3%. Revenue's only up 4.2%. They have declared an interim dividend of 15 cents. But this is also because they've discontinued a business called ScanMed in Poland that's been sold. But they are optimistic on adjustments of the outlook following COVID. Because things are getting back to normal, and remember they had to put in hospitals had to put in additional COVID protection, which kind of raised their cost base. But then at the same time, they couldn't do all those elective surgeries, which kind of hit their top line. So they kind of got a little bit of margin compression there. But all in all, they are looking Life Healthcare looking good. Our preferred in the sector is still Mediclinic. I hold Mediclinic in portfolios. If we have a look at, if we have a look at Netcare, Netcare is the third largest hospital group. Its revenue only up 2.3%, up to about 10.3 billion. Remember, they've got about 10,000 beds and 50 hospitals, but they're facing very, very much the same pressures that Life Healthcare is facing. Just in that margin compression. Staff costs up, but elective procedures down, but they are also seeing a return to normal, and they're seeing their margins recovering. They're paying a 20-cent dividend at the moment. Who haven't I done here? Okay, Togo-san. Let's go Togo-san. So I'm going to do these all very quickly. Togo-san is rebranding as Southern Sun, which is great because there's Togo-san Hotels and Togo-san Gaming. So Togo-san Hotels is rebranding as Southern Sun, which is great. They just came out with a trading statement. It was quite light on actual info. So we'll wait for the actual results, but nice recovery in revenue up 1.2 billion, from 1.2 billion to 2.7 billion. So big recovery. And we're seeing that also in the non-farm payroll numbers, which I'll chat about in a bit. But hospitality and leisure as a sector is definitely coming right. Looking at Grindrod and African Bank, so this is just a kind of a special situation announcement. Anthony chatted about it in his presentation as well. But there's a couple of hurdles, but Grindrod is essentially hived off their bank to African Bank, who's trying to enter the business banking space. African Bank will be paying 1.5 billion for Grindrod's bank. That's kind of double where the market really thought, what the market thought the bank was worth. So really puts Grindrod, I think, in a good place. Really shores up their balance sheet nicely. It still has to go through, obviously, the Prudential Authority, the National Credit Regulator, Competition Commission, Finance Minister approval. There's a lot of things, but it should also help African Bank, which should list in the second half of this year. As I said, we had Southern Palladium listing this morning, so a couple of listings coming to the exchange. Check that on Twitter. So if you want to go and see them blowing the kudu horn this morning, it's on my Twitter feed. But yeah, good for Grindrod, good for African Bank. Looks like a good deal, but I think Grindrod got maybe the better slice of that deal, but still looking good. African Bank, Grindrod, Sogo, that's all good. I'm not going to go through Old Mutual, but Old Mutual, okay, let's go quickly on Mutual. Risk and annuity business under pressure, life sales up about 19%. So Old Mutual looking good. Funds under management actually down 3%. Our preferred in the sector is currently Sanlam. Sanlam sits in the portfolios. ArcelorMittal, I think I've got that on here as well. ArcelorMittal, they concluded their strike. There's been a lot of strike action at Sibanye and ArcelorMittal. It's kind of strike season is coming to an end in South Africa. It's weird that we have to talk about strike season, but there you have it. Looking at pharmacies, Dis-Chem still, very, very growing, very, very acquisitively. You know, so they kind of said in their results, they're seeing a normalization of shopping habits, nice boost in revenue, but again, it's because of the integration of Medicare Group into their results. They've added 48 new pharmacies because of that transaction. If you look at their comparable numbers, revenue was only up around 6.1%. The stock is still pretty expensive, trading on a trailing 12 months of about 34. Obviously, that's also accounting for the transaction that they're doing. One of their growth opportunities, I think, is moving into basic healthcare insurance and gap cover. That said, pharmacies that are becoming insurers, it's a new type of business. So I think they just need to be careful of that as well. Who haven't I spoken about? Sorry, I know you guys asked for local stuff. Okay, cool. Spur. Okay, Spur. Okay, Spur. Yeah, John Dory's. Okay, let's maybe skip Spur for now. But basically, there was an overhang on Spur stock because GPL, Grand Parade Investments, was unbundling. That kind of overhang on stock is finished, so there could be some upside in Spur. It's currently, Anthony's got it rated as a hold. Famous Brands, Famous Brands also came out with results, revenue up 38%. It's super cheap, but I mean, it's difficult. It's obviously still reeling from that Gourmet Burger King acquisition. And I think things are coming right, but remember, a lot of these franchisees were hit very hard in COVID. Its market cap about 6.2 billion. It's still got a little bit of debt that it's paying down. The price is down over 20% year to date. We don't currently hold this. We've also got it on a hold. I think it's a difficult business at the moment. It's still a very competitive business. I'll chat about, I don't think we have Goldfields on here. Okay, Goldfields. We'll talk about the Goldfields transaction quickly. So Goldfields, obviously, okay, so this is an indication on I think it's on the 23rd of July, I'm going to be doing a presentation for the JSC just on the commodity sector and where the commodities have peaked. Now, one of the things that generally indicate a top in the commodity market is when CEOs start doing crazy transactions to try and acquire ore bodies and different assets. It might have been the case with Goldfields this month that that's what they did. So they've announced an acquisition of Yamana Gold, which is a Toronto-listed gold miner. Unfortunately, they're paying around a 33% premium. It's an all-share deal for the company. Most of these transactions historically have gone through at cost. So well, at cost, but they go through with no premium and no discount. That's typically where a gold mining transaction should go through. So the fact that Goldfields is paying up significantly with its own shares is not a good sign. If you look at the historical PEs of Goldfields versus Yamana Gold, Goldfields trades on about 11, Yamana Gold trades on around a 34 PE. So there is huge earnings dilution in this transaction. At the same time, if you want to get more ounces, what do? You've got to, and you have to do transactions to get them. I mean, remember, gold miners just get deeper and more expensive, and eventually run out of gold. And if you don't replace replace your mines, you won't be a company anymore. Now, is that a good thing or bad thing? I don't know. If you just pay it all out in dividends as a shareholder, if you're valuing the company correctly, you basically, you're getting all future cash flows recognized in the share price now, and that's how you value a company. But still, they want to extend their life of mines. I'm sure they will want to, translate their technical expertise into other ore bodies. This is going to extend their life of mine to around 25 years. They're basically going to go up to around 81 million ounces of provable reserves. It looks expensive. Chris Griffiths has been all over Twitter with a promoted campaign telling us why it's such a good deal. You were saying things like, we didn't find this in a pub. We didn't just meet someone. We've done a lot of analysis on which company to buy. And the one thing I will say, though, is that obviously Sibanye-Stillwater did a transaction like this, or Sibanye back then did this transaction with Stillwater. Everyone thought it was way too expensive. They were taking on too much debt, but it turned out to be a very positive move for the company. Goldfields, remember, only has South Deep left in its stables. So. Yep, that's Goldfields. A quick rundown of Goldfields. I'm going to skip Vodacom and Astral, otherwise we're going to run out of time. We can talk about it later if we still have time. I'm going to skip Sappi as well. But Sappi basically is managing to pass on its cost, even the graphic demand is quite tight. But yeah, so they're kind of almost a commodity producer, so doing quite well. Okay, that was a really quick rundown of what happened in the South African markets this month. because there was a lot of earnings. It's kind of like our own earnings season. So lots of trading statements coming out, lots of information. I think we had one of the busiest days in SENS ever. So I thought, let me just share that with you, because everyone says, oh, Gary, you always talk about international markets and international companies. Tell us about local companies. So there we go. I've quickly told you about a lot of local companies. So now let's get back to, okay, that closes our equity portion of the presentation. Let's look at some economic indicators. Economic indicators. Interestingly, we've seen US inflation come down. So every month we just get like the next data point tacked on. We were hoping last month when we chatted about it, we were hoping for inflation in the US to drop to 8.1%. It dropped to an 8.3%. You know, we're going to get US CPI numbers out again this Friday. The hope is, the expectation is that they'll come in at 8.3% again. So for the first time in a long time, we're starting to see a little moderation in US inflation. Now, if US inflation can move under control, that I'm sure will settle nerves, and we should see a lift to equity markets. If it turns out, I don't think anyone's claiming inflation is transitory anymore, but if we see inflation dropping to 4 or 5% when supply chain disruptions work through the system, and we don't see significant wage increases, you might just see these equity markets hook around very, very aggressively, because the Fed, the view, and I think it's one of the views that we've been chatting about in our research meetings, is there's a real possibility that if growth, if the US doesn't slip into recession, and that just gives the Fed a little bit more wiggle room, and inflation starts to come down a little bit of its own accord, the Fed is only too keen to take the foot off the pedal. If there's any indication the Fed is taking the foot off the pedal of these, when I say pedal, the rate hike pedal, if the Fed slows down in its rate hiking path, or gives an indication that it might not be as hawkish, I think you can easily see markets fly, because we haven't really seen, until kind of the announcement that we're going to see retrenchments in that, from the likes of Elon Musk, we haven't really seen an impact on the underlying markets. It hasn't been a significant impact like to inflation. Remember, equities are inflation hedges. So obviously keep a close eye on inflation this Friday. I've got the quarterly, okay, it says annual, but it's actually quarterly numbers for US GDP growth. They're already sitting in 1 quarter of negative growth. If we get a second quarter of negative growth in the US, we will officially enter recession. Does that mean markets are going to collapse if the US goes into recession? No, because everyone is already starting to price in the fact that there is a recession. The stock market is a leading indicator for economic activity. So because the stock markets have collapsed, that's an indication people believe that we will go into recession. What's far more interesting is how deep is the recession going to be. That's what you need to look for in that economic number. Bottom right-hand corner, you're seeing the federal funds rate. Obviously, they are hiking. The Fed is getting very, very hawkish. The interest rates are still deeply negative. If we look at what interest rates at 1% in the US, with inflation of 8.3%, you're still talking about a 7.3% negative yield. That's far worse than putting your money in South Africa, for example, which we'll look at next. Quickly on the unemployment numbers, we had non-farm payroll numbers out last week, Friday, for the US. Unemployment rate is sticking at 3.6%. Now, this is the kind of official unemployment in the US. What are we seeing? Very similar picture to what we are seeing in the South African environment, what Torgelson was telling us. We're seeing a big recovery in hospitality and leisure. Restaurants are opening. People are traveling again. The pandemic is slowly being put behind us, and we can see that in the employment numbers. We can see that in the earnings numbers. We can hear it in the corporate updates. So it does seem like COVID is now firmly in the rearview mirror, even though Shanghai was still locked down and Hong Kong was getting record cases. So with the strong number, the reaction from the market when that like non-farm payroll number came out was the S&P almost immediately collapsed. It was over 1.5% down. Why is that? We've almost got to the situation where good numbers are bad numbers. If the US employment figures are too strong, that means that you're going to see wage prices starting to increase. People are going to say, hey, wait a minute, there's no unemployment here. We want more money for our labor. And when that happens, the inflation almost becomes entrenched. Remember, real wages in the US, I think, are at about 40-year lows. So the inflation that's already come through the system has compressed the cost of labor in the US. So you are going to need to see wage prices starting to increase, which again, if wage prices increase, then companies' costs go up. They've got to hike their product. They've got to hike their product prices because if they can't hike their product prices, how are they going to pay their employees? And that inflation does become very, very entrenched in the system. So it is a real fear. The one kind of optimistic note on the non-farm payrolls was the average hourly earnings. The average hourly earnings rose by 5.2%, and that was much less than expected. So that was kind of a hint of optimism just in one of the sub numbers underneath it. Remember, we got a rise of 390,000 on the payrolls number. We were expecting 328,000. So it kind of beat there, but it kind of missed on the average hourly earnings, which is a good thing because that just it means that inflation might be, might be slightly more constrained than the market was expecting, and all we really care about is expectations. Looking at the SA inflation rate, we've largely been avoiding this, if you want to put it that way. So you can see obviously inflation at 5.9%. Depending on where you look at our interest rates, there's many different types of interest rates, but repo rate just below 5%. I mean, we still have a negative real interest rate, but it's far less so than the US. Our inflation seems to be in control now. I think our Reserve Bank is a little bit more forward-looking. So our Reserve Bank is kind of a little bit ahead of the curve, where the Fed seems to be a little bit behind the curve. And for that reason, our inflation is far more under control. Also, obviously, we benefit from the higher commodity prices as a country, and that's feeding into the system as well. Looking at the South African unemployment numbers, remember we did a presentation at the beginning of the year. What do we think? We actually said we don't think unemployment is going to drop below 35%, the official unemployment number. It has. So we've missed out on that prediction. I think it was 25 bold predictions for the year. So we are now just under 35%. Still terrible, but it does end 7 quarters. It's the first time we've seen unemployment start to moderate in South Africa. And that's really, really good news. I'm so happy that we're wrong on that one. The problem in South Africa, though, isn't obviously the official unemployment rate. It's the expanded definition of unemployment, including people that have given up seeking work, because obviously you're only unemployed if you're still looking for a job. So 45%, it's now 45.5%, down from 46.2% in the expanded definition of unemployment. But the real pain is being felt in the youth unemployment. So if you look at people aged 15 to 24, not studying, but looking for that kind of unskilled labor, unemployment is at 63.9% in South Africa, which is by far the worst on the planet. Outside, I suppose, maybe Ukraine, but I mean, there you're employed as a fighter. I don't think they're producing unemployment statistics anymore. But 25 to 34 segment, that's the age segment, still sitting at 42.1% unemployment. So unemployment is still a massive problem. It is structural in South Africa. Cutting interest rates isn't going to help our unemployment numbers. That's not going to make people go and borrow money and start businesses. The problem really for me has always been education. And you can see it so clearly in the graduate unemployment numbers in South Africa. Graduate unemployment is only at 12.6%. So if you are a graduate, if you have a tertiary education in South Africa, you are not facing ridiculous unemployment. The demand for skills in South Africa is massive. Before you go and immigrate and disappear overseas, if you're a young person, please come and send a job application to Ransford. We're always looking for bright young graduates. And I can tell you that we're not looking for unskilled laborers, unfortunately. So it's just one of those things. And obviously they are benefiting from the unemployment rate. We had South African GDP numbers yesterday. We expected 1.2%. GDP actually came in ahead of expectations at 1.9% on a quarter-on-quarter basis. Our GDP is expected to drop off, and we probably will get a negative print for the second quarter. And that's largely because of the flooding and damage in KwaZulu-Natal. That's obviously been a significant shock to the system. So I wouldn't be surprised if we see a negative quarter of growth in South Africa next year, but we are not at a risk of going into a recession. We have had a positive first quarter GDP growth. So 2 quarters makes a recession, 2 quarters of negative growth makes a recession. We are not there currently. Okay, that's the economics. So let's look at commodities quickly. Commodity markets. I always do this little blue square just to show where, that's the month. Commodity prices after moderating are back in upward mode. So S&P 500 is in green. So that's just giving an indication of what's happening to equity prices as these commodity prices surge. As I said, doing that JSE presentation on the 23rd, you can go to our website, just click on the events page if you want to register for that presentation. We're going to try and unpack whether this is the top of the commodity cycle. I'll do the commodity clock and a couple of other things. But yeah, it should be interesting. At the moment, commodity prices beat it. So I'm giving you two charts here. So this one is, I think it's a 2-year chart. Go back to, yeah, 3-year chart, 3-year chart, 2-year chart. There you go. I think it's a 2-year chart, actually. I can't read the bottom there. But 3-year chart. So you're looking at it over about 3 years. Yeah, commodity prices are beating. Like if you had just bought, into, like a general commodity basket, you would have done better than the S&P 500, which is always crazy for me because, looking at, when you buy into stocks and why do you invest in shares? Why do you want to buy a share of a company? Because a company pays you dividends. A company generates earnings that you get to have a share of as an equity investor. So the value of a company is in the innovation and the people that are creating value for you and your distribution of the economic effort. That's why you own a share. By owning a commodity, so if you go and say, I want to buy a brick of silver or a block of gold or Bitcoin, for example, heaven forbid, what happens is you're only generating value through scarcity. That's like going and buying like a old piece of paper. Why is an old map got value? Why does why do they say like the Mona Lisa is priceless? It's not because it's generating any real economic value in terms of it's not producing cars. It's not doing anything that you're going to get an earnings stream off. It's not, you haven't lent someone money who's going to give you your money back plus a little bit more money. It's not going to pay you a coupon. The way that like a Mona Lisa would generate value is just by being scarce. You can't recreate the Mona Lisa, and that's why it becomes priceless. Its value is only generated through scarcity. Now, like the reason that in the formal investment markets, things that generate value only from scarcity are considered alternative investments, whereas things that generate like a real return, like a bond market or an equity market, are traditional investments that you would put a pension fund in and not alternative investments. Now, over the last, say, 2 or 3 years, you've actually had just scarcity outperforming like real investments, which is crazy. It's horrible. And it shows that the system is deeply, deeply broken, and just the amount of the COVID shock has impacted us. But now, that's why I thought, let me give you a long-term chart now. Now, this is going back about 20 years. You can see why you don't want to just invest in scarcity. You want to invest in something that is a real investment that pays you a real return for giving away your capital. You go and buy a share, you're going to get the earnings of the company. You go buy a bond, you're going to get the coupon on your bond. So why do you want to do that? Because that's the return of something that you can see S&P 500. That's longer term. That compounding effect of actually getting more than just the scarcity is why you invest in equities. And sometimes people needed to be reminded of that. But let's look at the oil market. So I said I would talk briefly about what's going on at OPEC. So oil markets, you can see we've had oil prices rising again. So this is going back to, this is a year-to-date chart. So I've done all different time frames this time around. So this is a year-to-date chart. So all of the kind of little, I don't know how you want to call it, the codes are on the left-hand side for you, but the green code is LGOC1, which is low sulfur gas oil. That's up, that's doubled since the beginning of the year. If you look at LCOC1, that's Brent crude oil, so that should be the orange line. You can see that's up about 50% for the year. So obviously oil prices, back up at highs, we're back up at about $120 a barrel. So what did OPEC do in response to this? So OPEC was delivering around 432,000 barrels per day. That's what OPEC's output was. They looked at Shanghai, they looked at China, and they looked at the supernormal profits they were making, and they said, we're going to keep it. We'll keep kind of like, producing at this rate for July and August. But they have since said, okay, the oil market is a little bit tight. I've always maintained that OPEC doesn't really want the oil market this tight because, one, when you have $120 a barrel oil, other energy sources become crucial. The push into innovation towards battery and nuclear and any other way of, or the alternative energy sources becomes more and more appealing. And because of that, they kind of actually, for me, Saudi Arabia probably profit maximizes between $80 and $90 a barrel. That's kind of where they actually wanted to maximize volume and extend their life as long as possible. So they have increased output. The problem is, like, they've done it in a very sneaky way. When I say they've done it in a sneaky way, OPEC is obviously a collection of different countries. OPEC Plus includes Russia. Now, Russia, it's obviously had its exports banned by the European Union. There's also, the likes of Iran, which, have sanctions on them. There's no, like, the talks around sanctions haven't really progressed. You have operational issues in Nigeria and Venezuela. So what the OPEC did is said, we will increase. They're going to do a 50% output increase. So for July and August, they're going to produce 648,000 barrels per day. But they kind of meted it out across the different member states. So what that actually ended up doing was, it's actually said, oh, well, Iran, you can produce more barrels per day, but they can't sell it. So while they have increased the quota, like the headline quota to say that show they're coming to the party, there's real doubts whether the supply is going to come on stream. So even though they had a massive increase in output, technically, it doesn't look like they're going to be able to fulfill that output. And that's why we see oil prices almost immediately spike to $120 an ounce. Now, who benefits from that? The people that benefit are the people that can supply the market with oil. So it's going to be Iran, Saudi Arabia, UAE, and Kuwait that are the countries that are really going to benefit from the way that OPEC has put through the output increase. What that's done is obviously list energy markets and make all our lives a little bit more expensive. Fortunately, the petrol price didn't go up by 4 Rand a litre. I think it went up just over 2 Rand a litre because they've extended some of the government subsidies, but those are going to be recouped eventually. So we are facing higher transport costs. Getting ourselves around is expensive, and obviously getting all the goods and services around are expensive, which again feeds into the inflation picture. If I go look, okay, so I'm just going to look at softs quickly. So this is, again, we've seen a re-rating in the softs as well. So, KCCT2, which is iced coffee futures. What is it's not iced coffee, it's not frozen coffee. It's intercontinental exchange coffee futures. Futures that trade in intercontinental exchange are showing that we've seen a big spike in coffee prices. But the softs not kind of showing that big disruption that you're seeing in some of the grains and oilseed markets. Power complex also, power complex is incredibly elevated because of the high oil prices and because of, just almost an energy crisis in the European Union at the moment. So you can see also energy prices haven't subsided in any big way, still very volatile, but still very elevated. So I don't normally do the grains and oilseed chart, but I thought it's probably very topical. I know Anthony was talking about it. Viv's done a research note for you in the weekly note a couple of weeks ago around Malaysian palm oil and what's happening in the palm oil market. But all of these are inputs to our food prices. Now, obviously, you strip food prices out of core inflation, but they are in the actual inflation numbers. So, and we all do have to eat. So you can see what's happened and obviously we'll share these slides afterwards so that you can really go and just have a look at exactly what's happened. But you can see there's been a massive, massive increase over the last couple of years in input costs to things like to food production. And that is going to feed into the market. It's going to put enormous pressure on consumers. So the idea of just buying into consumer discretionary stocks, discretionary spend is going to be collapsed as people focus more and more on just those staple products. And it becomes more and more key to pick companies that, like Nampak, for example, that are able to pass on those price increases to their consumers. And that becomes crucial when listening to earnings calls. So I also just thought, so this is kind of, so this is like over the last couple of years. So I've just zoomed this out all the way to 2002, just to show you the state that we're in at the moment. So this has got energy prices on, but this is still the, anyway, so this is still the oil, at least grains and oilseed. And you can see massive increase. I mean, this is far more than we saw in 2008, 2009. There's a massive spike in underlying grain and oilseed prices. Food prices are going to increase dramatically over the next little bit. Be careful, increase your emergency funds. Do not, we are going into a difficult 18 months, as everyone tells me. Now, is it already in the price? So we've already seen it in the food prices are clearly already reflecting this. Is it in the security prices or not? I don't think it's yet on the shelves. So when you actually going to go and buy your bread and milk, it's going to get a lot more expensive. There's no question about that. It's already started moving up, but it will get more expensive. But that's a price that adjusts slowly. Food on the shelves doesn't adjust nearly as quick as a security price. A stock price adjusts almost instantaneously when new information comes available. Price on the shelves, there's certainly a delay there. Property prices, very slow, for example. So different things change at different speeds. Currency markets, let's look at currency markets quickly. So just to give you the poll, so last month we had a really weird poll. Only 14 people, only 14 analysts were polled. Yeah, we're back to about 20. It wasn't the major investment banks. We also had a crazy statistic from Morgan Stanley, which predicted the rand would go to 13.77 in the next couple of months. I'm really happy to say whoever the analyst was that submitted that at Morgan Stanley, maybe he's been fired or she's been fired. But what's happened now is Morgan Stanley's put in a far more reasonable result. So we can kind of look at that median number in a little more clearly now, because Morgan Stanley, remember, is the second best ranked contributor to the poll. In the smart estimate, they actually get upweighted dramatically. So your smart estimate last month was that we're going to go to 1453 in the next 12 months. It's now back to 1559. I did flag that and say, guys, just be careful. Morgan Stanley's skewing this. If you chop off Morgan Stanley, the numbers change quite dramatically. But yeah, I've got all the list there. So the top and bottom the top and bottom always gives me a nice indication of the range on the rand dollar if you're doing rand dollar transactions. Danske Bank is the most bearish. They're always pretty bearish, up at 17 rand to the dollar in the next 12 months. Standard Chartered, Goldman Sachs, both very bullish. Goldman Sachs is unchanged at 1450. Standard Chartered is at 1440. That's where they think the currency will be in the next 14 months. Of course, no one knows for sure, but the range does give you an indication. When we get towards, we're currently at about 1530 at the moment. We're starting to get to the lower side of the range. Last month, you'll remember I said we were at about 16, I think we're at 1620 or 1610, somewhere around there. No, 1610. I said, this is not the time to be taking currency out of South Africa. You get a good interest rate here. If anything, bring money back into South Africa. I said, when it goes the other way, then I'll start saying it's time to go. And I remember, I want you to come and invest in my offshore portfolios. I want you to take rands out of South Africa, more or less. Actually, I don't care. I mean, if you bring it back, put it in our South African portfolios. They're actually doing really well. But it's just, yeah, I think a lot of private clients are looking to internationalize their money. So we typically, the flow on our treasury desk is usually outward. So it's mainly people using those 1 million and 10 million rand allowances to move money out of the country. So normally I'm getting asked, when must I buy dollars? Not when must I take my dollars and buy rand. Normally when people have taken money out of the country, they're not bringing it back. Certainly not from a South African private client point of view. But I think we're getting to more reasonable levels. So we started dripping, we kind of put a freeze on outward, not freeze. I mean, you can always do it if you want to, but we were saying to clients, now listen, above 16, sit tight. We've allowed clients, when I say we've allowed, we've kind of said at 1550, we'll take money out. Again, it depends what you're going to do with money. If you're just going to sit in dollars, remember dollars have a big negative interest rate at the moment, a real interest rate that is. So sitting and earning a little bit of, remember, we've got a reasonable interest rate here. So if you don't think the country is going to collapse in the next 10 minutes, sitting and earning a little bit of interest while you wait for your right level is not a bad thing. On our cash accounts, which is where we put the money before we transfer it, we're paying above 5% on a call account. So you can have an instant payment out of the account if you need the funds. And it's above 5%. That's better than a lot of the bank's fixed deposit rates. So if you are looking at sitting on cash, give us a call. We've got some really nice rates at the moment. And while you're earning that 5%, you can kind of sit there, earn the 5% while you're looking for that rate. Now, where would I say the rate actually is? I'll reveal that in a little bit, but I think it's between 15 and 15.30. I think that's where we're going to turn. I think if you get down to the bottom of the range, which is the 14.40 to 14.50 again, borrow money and take it out. I'm not saying borrow money and take it out. I don't think you can actually do that if you're using SARB licenses, but you can do it via a currency contract. And I would probably put on it, like in my personal capacity, I would definitely put on a little rand dollar pair. Leave it up a little bit just to take advantage of that, because I don't think it'll hang around at 14.40, 14.50 for very long. So if you are looking to deploy capital, I would say 15 to 15.30 is probably the right level to get out again. You might get slightly better. Like I said, no one knows for sure on these things. So just dollar cost average, rand cost average, we can drip it out in multiple transactions if that makes sense. Investec 1565, Citigroup 1580, Nedbank 1585. You can kind of see where the guys are going for the next 6 months, 6 to 12 months. I thought I'll just share this chart as well. It's a little bit of a different one from our normal currency charts, and this is the dollar index. Dollar index is a basket of currency pairs that is looked at. It's euro, Swiss franc, Japanese yen. It's the Swedish krona, the pound, and I'm missing one. I can't remember the last one. Euro, Swedish krona. I can't remember the last one, but it's basically a basket of 6 currencies that the dollar is tracked against, and it gives an indication of really the US's largest trading partners. Now, I thought I'll give you a very uber long-term chart on this as well, just to show you, even though real interest rates are negative in the US, there's been a big appreciation of the dollar against its basket of trading partners. Now, why is that? The dollar is seen as a safe haven reserve currency of the world. It's a very good currency to hold, even though it does have deeply negative interest rates. It's why people will put up with that to hold dollars. But I just wanted to show you, if you're going to take money out and just go and sit in dollars, it's probably not the smartest thing to do longer term. One, I'm not saying we can't get to a dollar index of 120, for example. It's possible. I mean, we had that kind of dollar index appreciation in the the 1999 to 2002 .com bubble crash. A lot of people are comparing the sell-off that we're going through now to the .com crash and saying, hey, wait a minute, Gary, this could easily get to 120. I'm not saying it can't. Anything can happen in pricing. The world is a very uncertain place, but we are very, very elevated from a dollar index level of 90 just a couple of years ago. If things settle down, and the Fed starts to blink and we don't see those aggressive interest rate hikes coming through, you could easily see dollar weakness. You could see the dollar starting to move down again. My view is just sitting on a cash, like in cash like that, you can do it from a strategic point of view, but it's not the right way to do it. Like you should, if you're doing that longer term, you're not investing correctly. You should be in those asset classes that are generating something. Put it into a bond fund. I know bond funds have been hit, but you can go and buy a 10-year treasury and if you're going to sit on dollars for 10 years, why sit on dollars for 10 years? Sit on a 10-year treasury and get your 3% coupon every year, just under 3% coupon, if you're not going to do anything with the money and you're just sitting in dollars. But if you're going to sit on 10 years, equity markets are still going to give you the best return. But speak to one of the wealth managers. I'm sure they can structure that deposit for you a little bit better. Let's look at the pound quickly. They don't do polls on the pound like they do on US dollars, but you can see that we had this kind of long-term horizontal trend line that we were looking for support at around 1950. We've since broken below, and that's a very similar pattern to what we're seeing on the technical basis on the USD ZAR. 1550 was kind of looked like a long-term little, a little horizontal support. You had 2 tests back in the day. Quite a while ago. It has broken down below. So I'm still saying 1550, but bottom of the channel will take you to that 1450, 1440, 1450 on US dollar. Similar pattern being established on sterling rand. And you can see that, like we've had little breaks. So maybe you should be targeting around 19 if you're looking to buy pounds at the moment. I think there might be a little bit of downside, but I think you've got to be very, very quick. And there's no indication this is going to last. If we see, I think we might be in for a little bit of volatility on the currency also because of changes at the Reserve Bank recently. Rand franc, very, very similar. You know, I would expect that kind of decline trend line. You'd want to see a test there. I think you're going to get down to 1550 on the franc as well. So I do think we got a little bit of strengthening ahead in the currency, in the local currency. But once it hits those levels, kind of all bets are off. We could easily see a re-rating weaker. Again, I would get my deposits ready. Finally, the euro. We were looking at the euro last week, and I was just showing you guys some technicals on the euro. You can see that I've marked those little circles. That's when the RSI hit kind of the upper band, which is generally a sell signal on the pair. So that would be where you would be buying rand and selling euro. And you can see from those sell signals, which are the dotted lines, are just matching it. It is a lagging indicator, or it's almost it's a concurrent indicator. It happens all at the same time. But you can see we were right up there. And that's why last month I was just saying to you guys, like, yes, it does look like a little breakout of that downward trend line, but be careful. I think we're going to get strengthening. We have got strengthening. I still, and the same as the view on others, I think we're at far more reasonable levels. I think we're probably on this side of a good level to buy euros if you have rand. But, you know, in the next couple of weeks, I think you could quite easily see the RSI go to that oversold level. That will be your trigger to like ship your, you know, switch your dollars into euros. That's where I think the rate should be. I would probably say about between 16 and 1620 is where I would be taking currency out. And that is the currency market. So I said, like I said, we manage at Swissquote, Saxo Bank, and a whole lot of other places. Rand between 15 and 1535. That's where I would be getting my currency out. If you do want to take currency out, really simple, go and complete the application form on the RandSwiss website, randswiss.com/account. Send us an ID, proof of resident, proof of bank account, and you'll get your funding details and a welcome. Managed portfolios, let's take you, I'm just going to take you through. So often in the past, what's happened is people have asked us, what I see I had a couple of numbers drop off here, so I think everyone thought the presentation was over. But yeah, so we've had a couple of questions like about what else do we do, because I always talk about the global equity portfolio, what I'm doing in it, because it's a portfolio that I manage, and it's the rest are done with the research committee. They've got different structures, they've got different track records. So I always talk about the global equity portfolio because it's where most of my cash is, and it's the thing that I'm the most interested in, the most. It's where I believe it's our, what you call our flagship portfolio. It's where I believe the best returns are going to be generated over the next 5 to 10 years, and I'm happy to put clients into it, and I've got my own money in it as well. So global equity portfolio, we're just trying to beat the MSCI World Index, but the philosophy behind this is to go and buy big multinational blue chip companies and just ride them higher as they kind of compound. It's obviously going to be a high risk portfolio because it's 100% equity. As I said earlier in the presentation, there's a $50,000 minimum because we do it in segregated accounts. It's not a fund. A lot of people get confused by that. You're not buying units of a pooled investment that we have to pay a manco for. Why don't I want to unitize it as a fund? There's a lot of advantages to private clients to have a segregated direct investment in their names. One of the advantages is that you've got the granularity around your tax reporting. You can use up that 40,000 Rand exemption. You also have a massive amount of transparency on what's happening underneath it. I know we were thinking of doing an actively managed note for clients, but just the shenanigans and the execution behind the scenes can be quite high when you're using third-party trading firms. We prefer to do the trading in-house ourselves. It gives you better executions. Your execution fees are lower. And there's just more transparency. You can keep a very exact tab on the portfolio as well, and we don't have to pay manco costs. So we don't have to pay for a Cat3 administrator, and all of those cost savings will feed into your performance because you're getting closer to the underlying asset. It's why I like managing that way. It gives us that little kicker in performance. It makes us even, you know, like it's even competitive. Like, so even though we charge a 1% management fee, and I can take you guys through why we charge a 1% management fee, it makes our cost structure actually more comparable to a passive manager, even though we're doing active management for you. So it's, yeah, I think for me, it's the right structure if you really want to build wealth longer term. And it's also obviously got much more flexibility than some of the unitized portfolios and the CISs. So lots of things in it. And like I said, it is actively managed. And when I say actively managed, we're not sitting there buying and selling, buying and selling. We're trying to go and pick really good quality companies. We use, like I said, it's almost quasi-passive in that we use very stringent quantitative measures to select and screen companies. Once we have the company, we do, I would say it's top-down meets bottom-up. We take that top-down approach. We go and look at, are we overweight, US, underweight? We go and look at our geographic exposure. We look at our sector exposure. We pick what we want to be in. We go overweight, underweight. We screen out all the rubbish, and then we go and pick hopefully some really, really high quality companies. We generally tend to look at $100 billion market cap and above. It's not to say we don't have some smaller companies. We've got companies at like $25, $30 billion market cap. So there are some smaller companies in there as well. And there's reasons why each one is in there. But typically we're trying to capture growth from big multinationals like Google and Amazon and Nike and Nvidia and Pfizer, or the things that are up there. It's designed in response to our clients saying we want to put a nest egg overseas and we want it just to grow long term. We're not going to touch it for 10 years. This is where I believe you're going to get the best performance longer term. It's not incredibly speculative. Clients look at it, you're going to have volatility like we felt on the portfolio at the moment, because when equity markets collapse, it collapses. But we'll go through the performance stats now. But also remember that performance stats, I'm taking a point in time when I invested and when we started the portfolio. But everyone's going to have slightly different like experiences, because they start at different points in time. What you can say is over a 5-year period, we're always looking to invest in the best quality businesses at the best prices. Businesses that when we go through this, am I worried that any of the portfolio or any of the businesses that we hold are going to go bankrupt because of all the shenanigans that we're feeling now? Not at all. We're in the leading blue chip. It is a blue chip portfolio. That's what I'm trying to explain to you. If you understand the term blue chip, that's what this does. I'm happy to report we've had a very, very difficult 6 months on the portfolio. Obviously, it's been a horror show on equity markets recently. But yeah, I'm happy to report we are up 1.4% for the month. Now, again, don't look at monthly reporting. I report to you guys monthly. I come and give this presentation monthly. We do all I'm sure you look at your statements monthly, but looking at an equity portfolio on a monthly basis is not the right way of doing it. That said, we are up 1.4% for the month. Our benchmark is, so the benchmark also, like we're switching from Reuters to Bloomberg at the moment. So it's kind of making benchmarking. There's been a lot of discussion about the correct way of benchmarking. Most fund managers actually benchmark against an ETF so that they can show the fees that are being captured by their competitors as well. I prefer to benchmark against a raw index. But looking at the raw MSCI World Index, it's up about, I think it's about 12 basis points this month. We're up 1.4% for the month. So we have beaten by a comfortable margin this month. The price index, which is what the charts are based on, that's actually down about 10 basis points for the month. So there's a slight difference because of the one is a total return index, the other isn't a total return index. Like I said, the benchmark becomes very important when someone's taking performance fees. And to give you an idea of what the portfolio is trying to achieve. That's the purpose of a benchmark. Remember, we take no performance fees. If we go back to here, my performance fees are zero, not because I'm a rubbish manager. We have outperformed very significantly, and I'll show that on the next slide. But I don't believe in taking performance fees because I believe it incentivizes the wrong behavior in your portfolio manager. A portfolio manager that's being incentivized on performance fees is only looking at one side of the equation. They're looking at trying to generate the highest performance. They're not taking into account per given unit of risk, which is absolutely crucial for us. We want to generate performance, but we want to generate it in risk-adjusted terms. We want to make sure that we have you as a happy client for a long time. And the way that I do that is I incentivize myself on AUM instead. So you pay like on assets under management, you pay your 1% fee. And that means, like I said, we did an exercise a while ago. We only actually break even on our clients, on the average client, after 3 years. So after you need to be my client for 3 years before I'm actually going to start making a profit on the cost of acquisition and the infrastructure and all the things that we've got to pay to run your portfolio. So what that's incentivizing for me is a long-term view on the portfolio. It's incentivizing that I want you for a client for 5, 10, 15 years, and I need to keep you happy. That is correctly getting performance in risk-adjusted terms. So like I said, I'm sharing these stats with you, but think about the stats as well. It's not just about, oh, look, he's outperformed. Oh, look, that's a good portfolio. That's not the right way to think about it. Oh, he outperformed this month. It's time to get in. Like I said, it has been a difficult 6 months on the portfolio. So these are our performance stats. The red line is us versus the MSCI World Index. You can see that there's a nice outperformance. We've gone through a period of underperformance. So that gap between there has narrowed because we've gone through about 6 months of underperformance. And you can see it, like we've fallen a little bit more than our index. We've fallen a little bit, you know, it's been 6 months. The last 6 months have been very difficult for us. A lot of people say, oh, it's because you're a tech fund and you're just putting too much in tech weighting. We were overweight tech. We still remain overweight tech. I still think tech is good, but we overweight very specific kinds of tech. We've never invested in Zoom or you know, these really, we're not Kathy Wood's ARK ETF, and I actually did it for a client earlier today, where we they unfortunately went like it's kind of a friend client, if you want to put it that way. So they phoned in, or they came to us and said they wanted to buy the Kathy Wood ARK ETFs, the Genomic Revolution ETF. They bought 3 Kathy Wood ARK ETFs. Right in the hype of when tech was just in that like super bubble, and you know, we were getting rubbish listing on the NASDAQ, and you know, just crazy things were happening in the tech valuations. And I was sitting in these presentations, I don't understand how you value this. Like, are you valuing so much future growth? Like, it really is priced for perfection. I've never even owned Tesla, to my detriment. I wish I had owned Tesla at certain times, but it also comes down to timing. So anyway, the point of the story is we looked at their portfolio. Over the period, they're down about 50% on Kathy Wood's ARK structure. Over the same period, our portfolio is up 12%. So if they'd invested with us, instead of going and buying just these Kathy Wood ARK ETFs, they would have been up 12% versus down 50. I mean, it's a 62% swing on a decision. So like, I really do believe this is the best possible use of clients' cash than what we're doing. But yeah, like I said, we've had a very difficult, so we've underperformed the MSCI World Index, but we've still had, you know, you've got to take this in context that it is a longer term portfolio. The graph on the left is a relative outperformance. So we can see there, like we've gone through like a place where we've given up some of our relative outperformance after a nice period of kind of accelerating our performance into the collapse. We did very, very well in the COVID collapse, but we haven't done so well in the kind of like slow puncture that we've had in the second round of COVID collapse as interest rates have started to rise. And part of that is because some of the positions that have grown bigger, and I took you guys last month through our NVIDIA position and how, you know, what responsible portfolio manager, what you're getting when you come to us, what are you paying for? That's how we bought into NVIDIA. NVIDIA fell, we bought a little bit more. Then NVIDIA popped and became 10% of the portfolio because it just did so well. Then we trimmed it, again and got it back in within basically the concentration limits that we apply to the portfolio. And that's what you're paying a portfolio manager to do. It's not to predict the future. We can go and pick really good companies, but I can't tell you where the bottom of a sell-off is or where the top of the market is. That's not my job. And if that's what you're hoping for me to do for you, I'm probably not the right portfolio manager for you. But yeah, we've given us performance. I hope this is the turn. Now this is just the performance stats on the overall portfolio. So you can see this is real stats drawn off the system. You can see, okay, I mean 2017 we made 21.8%. These are all after cost statistics. Then 2018 we went negative 3.6%. Again, massively outperforming that year. The MSCI World I think was down about 9% that year. We were only down 3.6%. And you can see that was that little sell-off in January 2019, because it was almost unfair on annual reporting, because like you got this big sell-off into the annual report and then it kicked up, which kind of boosted the next year's result big time. So the next year we made almost 30% in dollars after costs, but that should be kind of, think about that more as 15 and 15 if you just move the year by 1 month, if you know what I'm saying. 18% the year after that, 19.9% the year after that. So that's kind of the thing. And we're down 15% for the year. So we are getting hammered this year, like it is no question. Now, how does that look compared to other markets? NASDAQ is down 23% for this year. So NASDAQ, we're not a tech fund. Like NASDAQ is getting hammered. Hang Seng was down about, so Hang Seng has recovered nicely. Like I said, we've had a big kick up. They're down about 7%. South Africa, after being a perennial underperformer, and I think last month I showed you compared to the long term in South Africa, we're up about, from inception, we're up about just under 90% in US dollars over just over a 5-year period. South Africa is only up about 30% over that period. So we've done almost 3 times the South African market over the duration. But this year, if you're looking like sorry, these are year-to-date numbers. Year-to-date numbers, South Africa is doing exceptionally well. Why is that? There's this big upswell in commodity prices, the likes of Billiton and Anglo Gold and all the Anglo-American, at least, Glencore, all the listed South African miners. Like I said, we had a new miner listing today. They are what has been boosting the JSE. And if you haven't been invested in commodities, you've kind of been on the sidelines. Now, on the 23rd, as I said, for the JSE, we're going to discuss whether it's too late to invest in commodities or not. And it's always going to have to make some difficult calls there as well. But I suppose that's what PMs have to do. The UK is actually up almost 3%. Now, we have a UK portfolio, which I'm going to show you in the next slide. UK is up almost 3% this year. UK has done nothing for 5 years and is now up 3%. Why is that the case? Because the UK is kind of a mix between financials and resource companies. It's got Royal Dutch Shell. It's got BP on the exchange. It's got Rio Tinto. It's got a lot of those commodity companies that have done well because of those rising commodity prices. So that's why you're seeing those UK ETFs ticking up. Eurostox is obviously Eurostox is very cheap. There's a margin of safety to the Eurostox, which is why you're seeing a kick up there. So I was chatting to a client. So that's kind of the performance you can see. Oh, so the last thing, Electronic Arts. Okay, Electronic Arts is kind of like merger deals that also came out with a really stellar set of numbers. I know I went through South Africa numbers this month. Maybe I'll include it in next month's presentation. But we got a big kicker on Electronic Arts. We backed the company for a long time. I still think gaming industry is a very interesting place to invest, but we've got the kicker there. Since inception, I just want to also point out, NVIDIA is still our largest gainer over a long period of time. The value companies that we've put in specifically to ride out the value storm, things like General Motors, are actually one of our biggest losers. You know, we like General Motors. It's like on a 5 PE. There should be a margin of safety to get you through these very, very difficult times. They're doing exciting things in the move to EVs, but it's not just a case of shifting your strategy all the time, and that's why, like I said, we kind of believe in the methodology that we said, and if we go through a difficult 6 months, I'm quite confident that we'll get it right. So now I just want to look at some of the other portfolios and just explain them. So we actually do run a UK equity portfolio for clients as well. We have for a long time. So this is basically like just a snapshot of the UK equity portfolio. And you can see the UK, like I said, like while the portfolio, like the global multinational blue chip type companies are down in the sell-off because they're very efficiently priced, and the UK has actually done particularly well. You can see that the UK, over time, and this portfolio, this portfolio specifically goes back to kind of October 2016. The UK is only up 6.77% over the period. The UK has not been a massive generator of wealth for clients. We went through Brexit. There was a lot of issues in that thing. Randswiss UK version of the portfolio, where we go and apply the same methodology that we do to global stocks, to the big multinationals, which are usually, we can usually get on US exchanges as our preferred jurisdiction. The UK portfolio is kind of a little bit more conservative. We hold things like, it's more a high dividend play for us, but you can see the type of companies that we invest in there. We've got things like National Grid in that portfolio. We have a little bit of Barrick Gold in there, which has actually done very, very well. Because this portfolio acts as a complementary portfolio to our existing clients. For someone that has a sterling balance and they specifically want to be linked to the UK economy, or the UK markets, all we're trying to do is say our benchmark is the FTSE 100. Can we beat the benchmark? Over the period, we've way exceeded the benchmark after costs. We're up 22% in pounds versus the FTSE 100, which is only up just under 7%. But is this something that I would go and plow all my cash into? Probably not. And I was chatting to a client about weightings recently. Like, now weightings are very, very personal, because this should be done in conjunction with a wealth manager. If you're immigrating to the UK and you have businesses linked to the UK economy, that would change your weightings. There's a lot of things that would change your weightings. Your age profile changes the weightings, because the risk metrics on this portfolio are different. Now, but as a diversifying factor, the kind of rule that I use is I would put, like if I just had to go for optimal allocation across our different portfolios, I'd probably say 10 to 15% probably 10% in the UK portfolio, 10% in the European portfolio, 10 to 15% in the tech portfolio, and the balance in the global equity portfolio. If I had to do an optimal kind of weighting of how would I just split these portfolios. Again, that's not the right way of doing it, but that's kind of like my feeling, where the bulk should be sitting in those kind of big international blue chips. It would be if I was talking only about your equity allocation and I was trying to maximize your return for unit of risk, that's what I would do. But you can kind of see the type of stocks in there. Now, again, we have like a European portfolio as well. Now, this one, we actually, again, you see different mechanics to these things. And this is why I don't normally chat about them with clients, because we build a track record and their product launches that we've done. We started implementing this. This one we were doing as a mini basket, so it wasn't. It was an idea for a product that we weren't going to track it like we track the global equity portfolio, where we produce fact sheets, and there's a lot of work that goes into doing like a full portfolio. So instead, what we're going to just do a mini basket where it was just equally weighted, and we weren't going to track it and match clients to an underlying seed portfolio. There was a little bit of like differences in mechanics. So we just did this as the Euro stocks. We kind of half implemented. Again, we're down 3% on this, but it's only got just over a year's track record so far. We're still sitting very, very heavy in cash in this, because we kind of saw what was happening in Europe, pulled back. We've only just implemented ASML, which is like a semiconductor company in Europe. We've gone through some share splits. We've got things like process in there. It's just a mini basket that when someone says, hey, will you buy me some European stocks? I want to go into a European portfolio. This is the portfolio that we construct. And we monitor these companies, but it's not done in the same way. So that's why I don't feel it's fair to really compare it to our global equity portfolio. But clients always ask about it, and the viewers on this channel have asked about it before. So I thought, let me just show you kind of where we're at on the UK portfolio. And then, as I said, the South African equity portfolio is also something that I often get asked about. You can see, like, this is, and again, this is an account that sits on the DMA system. We actually run the South African portfolios in BDA accounts at Momentum Securities. They don't have the nice reporting framework, and we, like I said, we're switching from Bloomberg to Reuters, at least Reuters to Bloomberg. So I don't have like a single reporting framework to give you at the moment, which will make it nice. So I've just had to take a client account, which we've obviously wiped off the information, but it does match our strategy exactly. The strategy runs for a little bit longer, but this gives you an indication of what we hold. We hold the likes of, it's everything that if you see me in the media, it's all the stuff that I usually talk about in the media. I like MTN over Vodacom. We have Sasol in the portfolio. I like ShopRite over the rest. We have Mr. Price in the portfolio. I've already said that earlier in the presentation as well. Richmond, Billiton, First Rand. First Rand has always been our preferred bank. So it's all the stuff that I talk about in the media. Those are our favorite companies. It's wrapped together in a portfolio where we do kind of active portfolio management for that. But and that's kind of how it's performed. It's South Africa over the last year and a half, up 8%. We're up about 18%. So we're doing well. We've done well in these portfolios, but like I said, they're not formalized in the same way as the global equity portfolio is formalized. But we're hoping to change that in the near future, and then we will have I think we'll have better reporting techniques for you on those portfolios, and then I can chat about them more in this presentation. Of course, if you are very, very nervous, so this is a structure. We had Yapi from Investec chatting about it on Monday. If you guys didn't catch the presentation, it is on YouTube. This is just a medium risk structure idea. I did chat about it last month as well. I'm going to use it this month more as a comparison. If you're looking at your equity portfolio, drawdowns, everything is so crazy, you might want to consider looking at a medium risk product instead. Speak to one of our wealth managers, understand who you are as a person, what kind of risk should your capital be at. This is a lovely product. It's got 100% capital protection. It doesn't actually matter what happens in markets. The only risk of taking an equity, taking a downside because of market performance here is if there's a credit event on the underlying company, which is it's an Investec product. There's liquidity on the product, and obviously you're getting basically 120% participation in essentially like a basket of indices that more or less makes up the MSCI World Index. It's actually a little light on the US. The MSCI World Index is actually heavier than 45%. So it's not quite the MSCI World Index, but it's a basket of companies overseas. You'll get, that's going to close on the 22nd of June. It's a Guernsey product, so there's all these great tax advantages. We really do like this product, so I would just say go watch the full video of Yapi explaining it if you're interested. 5-year minimum investment, 5-year investment. There is liquidity, so you can get out early, but your capital protection requires you to stay in for 5 years. $19,000 kind of minimum starting investment on this one. And what it essentially creates for you is this investment payoff profile. So you get, if the market falls 70%, your return is going to be 100%. So all the way from 100% and less, so any negative, you're going to outperform the market, because if the market is negative, you get all your money back. Great. There's a little bit of gearing in it, so you should outperform on the way up as well. And the place that you underperform is it caps at 40%, but it should be a 1.2 times gearing in it. So if it actually goes to 40%, you are going to get more than 40%, but you're going to hit that solid cap. So if the markets are really strong and go and run, and they're 200% up over the next 2 years, this is probably not the product for you, but it is something to consider if you're very, very nervous about markets. Personally speaking, I think a lot of, I don't know if we're going down another 10, 15, 20%. I don't know if you must go listen to Michael Burry and we go in for the mother of all crashes. I don't know if the very emotive language that's being used by people like Jamie Dimon, saying that we're in the hurricane, we're in an economic hurricane, and batten down the hatches, et cetera, et cetera. I don't know if that's true, because when people are speaking that way, often it's already insecurity prices, and that's what I hope I'm trying to get through to you in this portfolio, in this presentation at least. We might be in for another 10% down. We might be in for another 20% down, but we are, like, markets are heavily down at the moment. So for me, we're dripping in new money. For the first 6 months, we've kind of been sitting on the sidelines. So we've been quite aggressive on new implementations. If you had given us money 3 months ago, you would have seen almost no movement for 2 months, but this month you would have seen probably 40% of your portfolio go into the market. That's kind of what we feeling like on implementations. So you could remember, we often do phased implementations. We give you an option, but yeah, that's where we're at the moment. So thank you everyone for listening. It's always a pleasure to chat to you guys. I've gone again over, but at least we cut it at an hour for the YouTube channel. Okay, I've got quite a few questions. OPIC is pulling in the dosh. Yes, OPIC is definitely pulling in the dosh. Okay, question on Astral. I didn't get to Astral, so let's have a look at Astral. I'll pull up my notes. Astral, I mean, the problem with Astral, well, not the problem, but like Astral is facing kind of obviously massive increase in input costs. But the beauty of the likes of Astral is that they're actually doing fairly well, because they've obviously got all that protection in place. Now, if you are particularly interested in Astral, Anthony, at least Andrew, like I'll check the account with you as well. I mean, obviously we've got Anthony that covers it, so I've got full proper sell side, like institutional grade research notes around Astral that I can share with you. But overall, their cash pile is picking up. I mean, they paid a decent interim dividend as well. Headline earnings per share, up massively, in the latest earnings. I think they're up 130, HEPS were up 137%. So massive. Broiler sales volumes are up. Astral also, just in terms of, they've been investing heavily in their production and processing. And the CEO was just saying how that production and processing is really just feeding into their bottom line now. with higher prices as well. So they're very happy that that was put in place. But again, I'd rather get you an Anthony note, but I've got to check your account just to make sure that you qualify. We've still got a couple of slots left for Anthony's research that we can distribute to clients. Obviously, you have to be a client to receive it. And you have to be a private broker client as well. We can't distribute to online clients, and there's kind of like very strict rules around how we disseminate it. But I do have a couple of slots left on the list. So if you are interested in getting Anthony's research, just pop me a mail to gary@randswiss.com, and I'll see if I can add you to the list. Great presentation as usual, Gary. Thank you. I don't know if they're always great. Could someone send me all the required details for investor transferring grants? Okay, cool, brilliant. Okay, cool. So that's just, yeah, we will definitely get that to you. You'll probably chat to Christo. He'll take you through the basics of actually doing the international transfer. How many equities do you have in your global managed portfolio? Currently, we're sitting on 29 equity counters in the portfolio. You know, we kind of fluctuate between, I'd say, 23 and 25 over historically. Sorry, 23 and 30 historically. It is fairly concentrated. I don't mind concentrating it. I don't mind going down to like 20 securities if we really believe what we're doing is right. But we try and keep the weighting of any single security under 10%, and that's just kind of prudent management because of the mandate and because of the type of money that clients have given us. You know, when Google gets the 10%, I'll trim it. When Nvidia got to 10%, I trimmed it down to 5%. You essentially lock in the gains. You also, I like to reweight just once a year, just to trim off, like on the average portfolio size. Let's say the average portfolio size is probably sitting at like, you know, 3-4 million in the account. I just want to trim enough that guys can use their capital gains exemption as well. It's not ever going to be perfect. A lot of clients, you know, if they, you know, they want to manage their tax affairs more granularly, either stick it in a trust and then then it doesn't matter. We can do all sorts of things, and we've got lots of clients that sit in the trust. So then it makes it a lot easier from a tax planning point of view. But I'd say just for the average client, that's useful. We do give clients an option also to say, don't sell any stock of mine because they want to manage the sales themselves. So we create a sub account and we move it. So let's say we're going to trim Nvidia, but you don't want us to sell. We then do a move for you. So we'll just put your Nvidia. So I'll say I'm trimming to 0.5% so that my performance on your system, when you go and vet my performance, is going to match what I'm saying in these presentations. But you then have the option to sell the Nvidia whenever you like. So if you want to say sell it in the next tax year because this year you sold a big property and you're in for a big CGT bill, but next year you're not going to have it, we have that option for clients as well. So like, I mean, we're here to work with you on the portfolios to try and make sure that you are happy. And sorry, that was a very long way of explaining that we have 20 to 30 securities, but at the moment we're sitting on 29 securities in the portfolio. And that's why we need the $50,000 minimum, unfortunately. Like we've let clients in at like at kind of $30,000, but you kind of, you know, it's not like I'm buying $1,000 per security, which is the problem, because some securities are at 10%, others are, I think, so then you suddenly end up doing transactions for the clients at like $500, $600, $700. And it just becomes prohibitive from a cost point of view to do trades that small for a client, which is, you see, and this is the benefit of CIS. This is why collective investment schemes, mutual funds work, because it works for very small clients. Like you can go and buy a couple of units and it's fine. The problem with the way that we manage is you get all the benefits of being in a seg portfolio, but the problem is we need larger account balances to start with. So it's kind of like one of those trade-offs. But I mean, we're kind of happy just put a lot of money. I don't know. Cool. I hope that answers all the questions. Thank you everyone for listening. We'll post this on YouTube as usual. We won't post the end section, but you guys will get the end section because you were obviously on the call, or you did register for the thing and you're a client. So you will get the presentation. Thank you everyone for listening. I hope you have a great day.